One man invented more technical indicators still used by traders today than almost anyone else in history. And he did it all in a single book, published in 1978. His name was J. Wells Wilder. And if you've ever heard of RSI, ATR, Parabolic SAR, or ADX, you've used his work. Today I'm testing one of his lesser-known but genuinely clever creations, the ADX Trend Strength System. Unlike most strategies that just react to price crossing a line, this one asks a smarter question first. Is there actually a strong trend happening right now, or is the market just noise? I'm coding that exact system and backtesting it on 10 years of real Tesla data. No cherry-picking, no curve fitting, just the raw numbers. Before he became one of the most influential figures in technical analysis, Wilder trained as a mechanical engineer and worked in real estate. That engineering background shows up clearly in how he approached markets, not through gut feeling or chart pattern folklore, but through precise, calculable formulas designed to measure specific things: momentum, volatility, and trend strength. In 1978, he published a slim book called New Concepts in Technical Trading Systems. In it, he introduced the Relative Strength Index, the Average True Range, Parabolic SAR, and the Directional Movement System, which includes ADX, for indicators that would go on to become permanent fixtures on every major charting platform, all from one author, in one book, within the same few hundred pages. Most trend-following signals share a common weakness. They treat every crossover the same way, whether the market is trending powerfully or just chopping sideways. A moving average crossover in a strong trend and the exact same crossover during a directionless, choppy period look identical to the signal, even though one is a real opportunity and the other is likely to be a false start. Wilder's directional movement system was built specifically to solve that problem. It has three components. The plus directional indicator, or plus DI, measures upward price movement. The minus directional indicator, or minus DI, measures downward price movement. When plus DI crosses above minus DI, that suggests buying pressure is starting to dominate. But here's the clever part. The third component, ADX, the average directional index, doesn't care about direction at all. It only measures the strength of whatever trend is currently in place, on a scale from roughly 0 to 100. A low ADX reading means the market is directionless and choppy, regardless of which way price is technically drifting. A high ADX reading, conventionally above 20 or 25, means a real, strong trend is underway. The ADX Trend Strength System uses these three pieces together. You don't just buy when plus DI crosses above minus DI. You only take that signal seriously when ADX confirms there's real trend strength behind it. In other words, the system is designed to filter out exactly the kind of false, low-conviction signals that plague simpler crossover strategies during sideways, choppy markets. For this backtest, I'm using the classic combination. Enter when plus DI crosses above minus DI, but only on days when ADX is above 20, confirming the market isn't just drifting aimlessly. For risk management, I'm using the same volatility-adjusted trailing stop used throughout this channel, 2 times the average true range, which, worth noting, is also a Wilder invention. So this entire backtest is really testing multiple pieces of his original toolkit working together. It's worth connecting this back to some of the other classic strategies tested on this channel. A simple moving average crossover, like the Golden Cross, or a basic breakout system, like the turtle trading approach, will generate a signal anytime their specific condition is met, full stop. They have no built-in concept of whether the broader market environment actually favors that kind of trade. The ADX system takes a fundamentally different stance. It's willing to sit on its hands and do nothing, even when a directional signal technically fires, if the surrounding trend strength doesn't back it up. That's a meaningfully more selective, more conditional approach to trading than most of the mechanical rule sets we've covered so far. Closer to how a discretionary trader might reason through a setup, just automated into a precise, repeatable formula instead of a gut feeling. Whether that added selectivity actually pays off, or whether it just means missing out on trades that would have worked anyway, is precisely what a rigorous backtest, rather than intuition about which approach sounds smarter, is designed to reveal. Here's exactly what I tested. ADX Trend Strength System, applied to Tesla, using 10 years of daily price data. Starting capital was $100,000. I chose Tesla for this test very deliberately. Tesla is one of the most volatile major stocks in the market, known for sharp, dramatic trends in both directions, punctuated by long stretches of chaotic, directionless chop. If any strategy is going to benefit from filtering out weak, low-conviction signals before committing capital, a stock with this personality is exactly the kind of environment where that filtering should matter most. So how did Wilder's trend strength filter perform on 10 years of real Tesla data? The strategy executed 33 trades, with a win rate of 27.3%. Total return came in at minus 56.5%, working out to a compound annual growth rate of minus 8.0% per year. For comparison, simply buying and holding Tesla over the same period returned plus 2,753.4%, or plus 39.8% annually. The strategy's maximum drawdown, the largest peak-to-trough decline an investor would have had to sit through, was minus 58.6%. The core idea behind this system is worth sitting with, regardless of how the exact numbers turned out. Adding a strength filter on top of a directional signal is a fundamentally different approach than most simple crossover strategies we've tested on this channel. Rather than asking, which way is momentum pointing, it first asks, is there enough real momentum here to be worth acting on at all? That extra filtering step tends to reduce the total number of trades taken, since plenty of directional crossovers get skipped when ADX doesn't confirm sufficient strength. Fewer trades means fewer opportunities to be whipsawed by noise, but it also means the system will sit out of the market during choppy periods that a simpler system might have traded through, for better or worse, depending on what those skip periods actually did. There's also a psychological dimension worth mentioning. A trader watching a stock like Tesla make a sharp directional move, without any confirmation that it's a genuine trend rather than a temporary spike, often feels intense pressure to act immediately, out of fear of missing the move entirely. A rule that mechanically waits for ADX confirmation removes that emotional urgency from the equation, for better or worse, since waiting for confirmation always means giving up some of the earliest, and sometimes most profitable, part of a move in exchange for higher conviction. What's notable about Wilder's broader body of work is how much of it was built around this same underlying philosophy. Don't just react to price. First, measure the conditions that make a signal trustworthy or untrustworthy in the first place. That's a meaningfully more sophisticated idea than most trend-following tools from the same era, and it's likely a big part of why ADX has remained a standard tool for professional traders specifically, not just retail chart watchers, for nearly 50 years now. Whether that added sophistication actually translates into better real-world results compared to simpler systems is exactly the kind of question that sounds obvious in theory, but only a real, honest backtest can actually answer. That's the ADX Trend Strength System, coded and backtested on real data. One man's attempt to separate real trends from market noise, put to an actual mechanical test almost 50 years after he first wrote it down. If you want to see more classic strategies tested